What if you could help your kids buy something important, like a home or even a stake in a business, without giving away your money outright and without putting your retirement at risk? That's what an intra-family loan can do when it's set up the right way. This isn't about handshakes or vague promises. It's about creating a clear, documented loan that keeps control in your hands, shifts future growth to your family, and avoids the jealousy or holiday drama that sometimes comes with gifts. So in this video, I want to walk you through how intra-family loans work, why they are such a powerful wealth transfer tool, and what guardrails you need in place to make sure it doesn't backfire. Let's break this down in plain English. An intra-family loan is exactly what it sounds like. You lend money to a family member, not a gift, not helping out with no strings attached, a loan. That means you set the terms. There is a promissory note, an interest rate, a repayment schedule. In other words, you act like a bank, but you are a bank that your kids or grandkids would much rather deal with. Now, here's why retirees love this. First, it shifts the growth. Imagine you loan your daughter $500,000 for a duplex. If that property doubles in value over the years, your estate still only shows a $500,000 note. The appreciation belongs to her. Second, you keep control. If life changes, you still hold the note. You decide what happens next. And third, it creates clarity. Instead of fuzzy memories or verbal promises, you have paperwork that speaks for you. And let me tell you, when family and money mix, clarity is your best friend. But there's more. These loans let you say yes when a bank might say no. You can lend any amount you are comfortable with, regardless of your child's credit score, and the interest rate you charge, the applicable federal rate, is usually much lower than what commercial lenders would offer. And here's some extra flexibility. If you decide later to forgive part of the loan, you can. And there are tax-smart ways to do it over time without creating tax headache. So where does this strategy shine the most? Think about the big moments when your family might need help. Buying a home is the most common. Instead of her paying a bank for 30 years, your daughter pays you with a lien on the house to make it official. You get steady payments and interest. She gets a home and the growth stays in her family line. Or maybe your son is buying into a business or medical practice. Instead of scrambling for expensive finances, you provide the capital. He gets ownership, you get a secured note, and everyone's clear on the terms. Sometimes it's bridge financing. The right property pops up, but the timing is tight. An intra-family loan gives your child a way to move quickly with the option to refinance later. And yes, in some cases, it can even be used to consolidate high-interest debt, but only if there is a clear repayment plan. Good intentions alone don't pay the bills. So whether it's a first home, a business buy-in, or seizing an opportunity that won't wait, these loans let you help your family while keeping your retirement safe. Now, here's where I need to stress something important. This only works if you treat it like a real loan. The IRS and the courts, if it ever came to that, don't care what you meant. They care what you did. So you need a paper trail that shows this is the real deal. That means charging interest at or above the IRS rate of the month you sign. It's called the applicable federal rate, or AFR, and it's updated monthly. Writing up a proper promissory note with the principal, interest, schedule, and even what happens if payments are late. Making sure payments actually happen. I recommend setting up automatic transfers so no one has to rely on memory. Securing the loan when it makes sense. A junior mortgage for real estate. A pledge of shares for a business. These aren't harsh. They are simply how lenders operate. And finally, keeping gifts and loans separate. If you ever forgive part of the loan, that's a gift at that moment, and you document it as such. The test is simple. Did you truly expect repayment? And did you act like a lender? If the answer is yes, and your paperwork shows it, you're in good shape. So what about taxes? Let's keep this simple. On your side, the interest payments you receive are taxable as ordinary income. The note itself sits on your balance sheet as an asset of your estate. On your child's side, whether they can deduct the interest depends on what the loan is for. If it's a rental property or a business, it's often deductible. If it's for their personal residence, the rules get trickier. But here's the bigger picture. Most retirees I work with aren't bumping up against the federal estate tax exemption. The real benefit isn't avoiding estate taxes. It's transferring future appreciation to the next generation while maintaining control today. And if you want to forgive payments down the road, that's fine. Just treat it as a gift when you do it, not before. Some families chip away gradually using the annual gift exclusion. Others keep the loan intact and settle it through the estate. Either way, documentation is key. Now, let's talk about the part that isn't in the tax code: family dynamics. Here's the truth. When one child gets help, others can feel left out. At least that's what I'm seeing in my personal experience. Even if the plan is perfectly fair, emotions run the show. This is why estate attorneys often suggest adding what's called an equalization clause. It's a way to make sure loans are accounted for fairly when assets are divided. Let's say you loan one child $300,000. Your estate documents can spell out that any unpaid balance at your passing gets subtracted from their share. That way, their siblings stay whole. And it doesn't have to be complicated. Sometimes a simple letter of intent can prevent years of resentment. You don't need to overshare every detail, but you do need to provide enough clarity so no one feels blindsided later. Because I'll tell you, I've seen more family disputes over perceived unfairness than over dollar amounts. Clarity now saves holidays later. If you are wondering how complicated this is to set up, it's actually pretty straightforward. First, you decide the purpose. Is it for a home, a business buy-in, or something else? Be specific. Then you pick the AFR that applies, short, mid, or long term, and lock that in. Next, make sure there is a promissory note in place, ideally drafted with your attorney, that spells out the key details. Consider whether collateral makes sense, especially if it's tied to real estate. Set up the payments, preferably automated, and keep a record. And finally, make sure the loan fits into your bigger plan. Start by talking with your financial advisor, then loop in your estate planning team. That's it. 6 steps and you are there. Now, there are some mistakes that can turn this smart strategy into a headache. The first is charging less than the AFR. That creates what the IRS calls imputed gifts, and it complicates everything. The second is not putting anything in writing. A verbal promise doesn't count, not with the IRS, not with the probate judge. The third is letting payments slide. If something changes, that's usually the point when attorneys recommend updating the note rather than just letting it drift. And the fourth is forgetting to tie it into your estate plan. Otherwise, you leave behind a puzzle for your heirs to solve, and I can promise they won't thank you for it. And here's the part many families often overlook. It's not just about having good paperwork at the start. You've got to treat the loan like a loan, year after year. That means real payments, real records, and enforcement if needed. Without that, even the best drafted loan can unravel. These mistakes are avoidable. All it takes is treating the loan with the seriousness it deserves. So why talk about this now? Because life doesn't wait. The right house comes on the market. A business partner suddenly wants to sell. A child needs to act fast to secure an opportunity. And too often, families either delay or throw together a handshake deal that ends in conflict. A properly structured intra-family loan means you can help your kids when it counts, protect your retirement by holding a secured note, and protect your legacy by keeping peace in the family. It's not just about the money. It's about preserving relationships and making sure the story of your family is one of support and clarity, not confusion and resentment. So what does it look like when things are done right or when they go wrong? Good facts mean a written promissory note, interest at or above the AFR, payments that actually happen, records to prove it, and a clear plan for how it fits into your estate. That's when the story is clear. No questions from the IRS, no fights between siblings. Bad facts mean no note, no payments, or a wink and nod agreement that someday this will be forgiven. That's how loans get reclassified as gifts, or worse, spark family battles in court. Take the estate of Bowles. A mother advanced millions to her kids with no paperwork or repayment. The IRS called it a gift, and the court agreed. Contrast that with the estate of Galley, where the IRS challenged the loan, but because there was documentation, AFR rates, and real payments, the family won. One path leads to clarity, the other leads to conflict, and it all comes down to documentation. Once you understand the basics, there is room to adapt. Some families structure the loan as interest only at first, with a balloon payment later. That gives the child time to stabilize before refinancing. Others prefer amortizing payments, which steadily reduce the balance. Some even make a loan to a trust instead of directly to a child, for asset protection or management purposes. And in certain cases, parents combine a loan with separate annual gifts to help with payments. But again, they keep those two things documented separately. The engine is the same. You are just choosing which vehicle works best for your family. So here's the big picture. Intra-family loans let you help your kids today without giving away your retirement security. They keep control in your hands. They shift growth to the next generation, and they create clarity that prevents conflict. The key is documentation. Treat it like the serious loan it is, and you'll create an arrangement that supports your family both financially and emotionally. And here's where I'll leave you. You've just seen how a family loan can move opportunity forward without gifting today. But sometimes a gift of equity is the smarter move. In this video, I'll compare the two side by side, so you can see which one creates less friction and more impact for your family.